Yes, welcome to financial accounting class. You can call this paper as financial accounting or advanced accountancy. Today I am going to talk basics of a final accounts, right? And after this session, you will be conversant with what is a final accounts, why should we prepare the final accounts, what are the content of a final accounts. Let us start the topic final accounts. So from this itself you can understand the basic meaning of the topic final accounts. This should be prepared finally, so it is called as a final accounts. For a year, for the entire period you are maintaining the accounts, all the transactions, financial transactions of the company, of the business, of that particular proprietary concern, whatever it may be, you are recording in the sense you are entering. And after entering the entire things as per the rule, at the end of after that March, at the after that current that financial year, you will have to summarize the activities in the form of final accounts. Of course, there is a change in the presentation of a final accounts. Previously, we had the presentation of a T-shaped accounting. One side is debit and another one side is credit items we entered. Whereas now it is based on the statement. But either a T-shaped accounting or a statement type, whatever it may be, the basic concept is final accounts that comprises three things. Of course, in this also currently we are using two things, trading and P&L account one, and another one is a balance sheet. What is a trading and P&L account? When the business is doing the trading, right, that is a sales, all the purchases and sales, related expenses, opening stock, closing stock are entered in this account. That is why this is called as a trading account. And the second one account is a profit and loss account. That profit and loss account, one side we have to enter the loss and expenses, and on the other side we should take the income and gains. See, you know very well basic rules of accounting. We are having three things, three fundamental rules of accounting, golden rules of accounting. It is very famous term, you might familiar in your plus 1 plus 2 accounts class. Golden rules of accounting. The first one account is personal account. It is related with the person. Debit the receiver, credit the giver. Second one is real account, that is cash and equivalent transactions are recorded in this account. Debit what comes in, credit what goes out. Third one, which is nominal account, right? Nominal account, debit all expenses and losses, credit all incomes and gains. Just you apply these three rules in first two categories of accounts: debit expenses, credit incomes and gains. And balance sheet is not an account, please mind it carefully. Only trading and P&L are the account. Balance sheet is not an account, it is a statement. See, in this you can find four items. Trial balance, from that final accounts are prepared, right? So please mind it, trial balance and balance sheet are not account. Both of the things are not account. It is, both the items are considered as, both the items are called as only the statement. So trading account, P&L account, balance sheet is a statement. So we can also call the balance sheet as position statement. Mind it, balance sheet is also called as a position statement. First two things are considered as income statement. Now we are calling it as income statement because we are not having the practice of T-shape accounting. So now we are calling these two things, trading and P&L, as an income statement. But strictly speaking, these two things are account. Only balance sheet, trial balance are called as a statement. So this chart, this clearly depicts what are all the items should be taken in final accounts. In trading, you should take direct expenses, opening stock, and purchases. These two things, these informations we have to take in the debit side of the trading account. Okay, so stock, opening stock we have to take, and credit side only closing stock we should take. So direct expenses, opening stock and purchases, what the materials that company or that business purchased for the period, for that notified period. Credit, what sales made for that notified period, what sort of a closing stock they are having. Closing stock should be in the credit side. Then another one is P&L account, debit indirect expenses. So if you are debiting indirect expense in P&L account, then where should you take the direct expense? In trading account and manufacturing. Before trading, we are having another one item called manufacturing expense. I will explain it separately. So indirect expense, then administrative expenses, then maintenance expenses. Okay, the entire amount of indirect expenses are categorized under these headings. Okay, maintenance expenses, then upkeep of a delivery van, upkeep of a showroom, maintenance of a showroom, all those things are maintenance expense. Salary paid to the staff, rent paid, telephone charges paid, administrative expenses, administration expenses. Then selling and distribution expenses. What is that selling and distribution expenses? Salesman's commission paid. Okay, delivery van charges paid. Those things are selling and distribution expenses. Then provisions made. What is that provision? I will tell you separately, but just you please understand the meaning. What is that provision? Amount provided for the period. See, March month salary paid in the month of April. So you are required to create the provision. That is one. And another one is what I am trying to explain it here for bad debts. I made the sales on credit basis. Some amount I am not able to collect some amount. So those things are considered as bad debt. And the end of the year, the provision should be created for that bad debt. What is that provision? That means amount provided for that item. I can collect that amount in future, whereas today for this accounting year, that amount is not collected. That will be collected in future. So now I am providing the amount. Commonly we used to call it as RBD. But please mind it carefully. Provision and reserve, both are different items. Okay, there is a pinpoint difference between the provision and the reserve, but we are using it in the same parlance. So, provision for bad debt, doubtful debt. Reserve created for bad debt, doubtful debt. Those things should be in debit side of P&L account. In this also separate 5 more question will be asked. How to create the RBD, and RBD new provision, RBD old provision, all those things we have to study. So here just you try to understand provisions should be recorded in the debit side of the P&L account. And another one, credit. What items should be taken in the credit? Incomes and gains. I told you, in nominal in nature, account will have expenses and losses in debit side, incomes and gains in the credit side. The result of this account is net profit. Mind it carefully. Result of first one item is gross profit. That should be carried over to the second account, which is called a net profit. Then finally, if it is the favorable balance, net profit, negative balance, net loss. Likewise, in the first one also, if it is a favorable balance, gross profit. If it is a negative balance, then gross loss. Whatever it may be, that should be transferred to the subsequent account, trading to net P&L account, from P&L to balance sheet, debit balance sheet, liability side of the balance sheet. Okay, balance sheet is a statement, whereas trading and P&L, when you are writing the items, that is stock or sales, when you are writing the direct expense, stock, indirect expense, administrative expenses, when you are writing these things, you should add prefix as to. Whereas if you are recording credit side items, you should write the prefix as by. Debtor to, creditor by. That is the actual meaning for these two things. Then balance sheet is a statement. In balance sheet it has two sides. Okay, now we are not preparing in two T-shape accounting type. Statement type only we are preparing, but you try to understand two sides it is having. One is liability side, right? What are all the items the company is having the liability? They are liable to pay the amount. Okay, they are liable. They are owed to others. They have to pay the amount. So liabilities. What are all the items should be taken in liability? Capital amount. What the capital they have contributed. See, now you are supposed to have one question, sir. I have started the business. I am investing the amount of capital. Then why it is a liability? Yes, based on business entity concept. You are separate, your business is separate. So capital, then reserves and surplus, what the amount of reserves you created, what the amount of profits you had, you secured. Then reserves, then current liabilities you are having, any other loan if you are having, that should also be entered in the liability. Assets side, you are having two categories of assets, fixed assets and current assets. The details of these items are clearly given in the textbook. You please refer it. For your benefit, you please refer it. Otherwise, I will tell you then and there when solving the problem. Then, what is the concept behind this balance sheet? It is both sides you are having, both sides are supposed to be tallied. So, one side is liability, equity and liabilities, and another one side is assets. So, you will have to take the concept of, you can formulate it in the form of the equation. Liabilities plus shareholder equity is equal to assets. Whatever the assets you are having is supposed to be tallied with the liability and shareholder equity, shareholder fund, or amount of capital plus a reserves and surplus, right? This is the concept. So whatever the things you are doing in final accounts, it is supposed to be based on basic rules of accounting and the concept. So next class we will discuss some more things.